All right. Hello, everyone. We'd like to welcome you to our annual Economic and Market Update webinar. I'm Mitchell Crowder, an advisor at Wealth Crossing and head of the investment committee. We're excited to have everybody join us. We're happy to be welcoming back Brad Long, managing partner and chief investment officer at Fiducient Advisors. Fiducient currently serves as a valuable investment research partner to us at Wealth Crossing, help us stay up to date on current investment topics and trends. As Fiducient Advisors Chief Investment Officer, Brad leads the firm's investment strategy and research efforts. He is the chair of the firm's investment committee and a member of the firm's discretionary committee, research forum, capital markets committee, and mission-aligned investing council. Brad plans to cover some key themes shaping today's markets and what that means for investors in 2026. We did want to go through a few logistical items before we get started. If you have any questions as we go, please feel free to type into the chat, and we'll plan to get to them at the end during a quick Q&A session. If you have any specific questions related to your individual situation, then your Wealth Crossing advisor will be happy to answer after the call. With those out of the way, I think we're ready to get started.
All right. Well, thanks, Mitchell, and appreciate everyone for dialing in and your time here this morning. If you are local to the Mid-Atlantic, hopefully the ice and snow has not slowed you down too much. I'm in balmy Chicago. It's just it's a nice 0 here, but no ice on the roads. So we'll begin. As Mitchell said, please feel free to put questions in the Q&A. We'll try to answer them throughout. If we don't get to them, we've got some time at the end. And then if we don't even hit it there, your advisor will follow up with you. Our compliance team was not available to join us in the call, but they did want to make sure that we got these in front of you. And with that out of the way, we'll jump in here. So as a reminder, each year we go through a process for developing our outlook for 2026 or the coming calendar year. Our outlook is always forward-looking, right? We do not have the luxury of looking in the rearview mirror and hoping that the past is representative of the future. We're looking forward, thinking what are the opportunities, what are the risks, and how that impacts our portfolios. So we will go through maybe a quick in the rearview mirror of what we thought for 2025 and how that came about, but then spend the majority of our time on 2026 and what that means for our portfolios and allocations. Now, very quick on the rearview mirror for 2025, entitled Bridging the Divide. We really talked about 3 key themes moving prices in last calendar year. It was fragility, durability, and the age of alpha. So this idea of markets are fully valued, that concentration amongst indices, and that we could see some volatility. We can tell you that Liberation Day in early April of 2025 really helped solidify that idea of fragility is in the markets. We came just within a hair of a bear market, down almost 20% in early April. But as we know now with hindsight, portfolios and assets were back off into the races. Durability, right? Frankly, the requirement as a result of fragility, you have high valuations, concentration, you have shifting geopolitical environments, whether that be economic policies, tariffs, geopolitical actions. We'll talk about Venezuela in a bit, but other circumstances really requiring us to think long and hard about how do we want to build durability into our portfolio and the way that it takes place throughout our asset allocation. And then age of alpha, we think that there are some really great opportunities in markets today to take advantage of some of these components. The cousin to volatility is opportunity, right? Without volatility, we would not have an opportunity to add, at least in the same way that we do in markets today. And so, we don't fear the potential volatility. We harness the potential volatility and take advantage of it. So, on a scorecard, give it a B+ and A-. Not everything, nor would it ever come out exactly as we thought in 2025. But we do think that actually 2025 in this foundation really lays a great framework for how we think about 2026. So, as we turn the calendar year, in this balmy January around the country and look to the rest of the year, we're really talking about 3 key themes, which we'll dive into through the rest of this program. One is the AI playbook. It feels like you can't walk 6 inches, especially in the investing world, but even outside of it, without bumping into a conversation with AI. So what does AI mean for our portfolios? Well, first, we're going to start with facts, right? Where are our portfolios with AI today? And then, maybe in this kind of Super Bowl season, right, we're going to talk about the offensive AI, right? What do we want to own and why do we want to own it? And the defensive AI, right? How to not be too exuberant in what can be an exuberant market. And then we'll also talk about the B word, right? Is AI in a bubble? Now, we don't use that word lightly, but we'll bring context to that. The second and most, one of the most things here is also navigating valuation. We are in a market today where things are fairly fully valued. To use a kind of a common parlance, it's expensive out there. There's not a lot of kind of easy money to be made, if you will. And so that doesn't mean that there are no opportunities. It just means we have to be very thoughtful about those opportunities and then weigh them against the potential risks, which we'll get into. And then finally is this idea of the noise resistant economy. Last year we threw at it a big, cardboard cutout with tariffs across the country in early April. We had a government shutdown. We had, a lot of discussion around Fed autonomy and cutting interest rates. We threw a lot at the economy, and yet here we are, GDP showing good quarter-over-quarter numbers. Labor, while very recently has been showing more indications of weakness. Unemployment still, in the mid or low fours, which is fairly full. And so, the economy continues to lug along, seemingly, noise resistant to all the things that we throw at it. And so, how do we package all this up and put it into our portfolios and what it means for you all in the coming calendar year? Well, first, let's talk about the economy. We are investors, not economists. I jokingly love to say, like, economists are like weathermen or women. They can be wrong most of the time, and there's very little consequence, right? We are investors, and there is consequence for being right and wrong. That being said, though, we need to keep a pulse on the economy. It helps set tone, right? When the economy is growing and robust, markets are more likely to be growing and robust. The inverse is true. If the economy is weak or weakening, markets are more likely to be weak or weakening. And so it helps us set the frame of, how much interest or disinterest do we have in, taking risks in the portfolio and how we set up portfolios for the long term. So the economy is big and there are a lot of elements to it. We're not going to get into all of them, but one of the ways that we help kind of distill key elements into the economy is through this diffusion index. This is actually run by a third party. They're a great sell side investment and economic analysis shop, and they pull out four key metrics around the economy and put them into basic categories: assets, things that are going well; liabilities, things that are not going well; and then neutral, the things that are kind of stuck in the middle. The more column, the more you have in the assets column, the better and more robust the outlook is for the economy is. More in liabilities, the inverse. And as you can see here, we've got a lot that are kind of stuck in that neutral range. They're stuck in mid-gear. Now, as I mentioned, GDP is robust. Labor is fairly tight, right, at 4%. While inflation's above the Fed's target, it's still in a very modest range at under 3%, call it between 2 and 3. So the economy objectively, especially in the rearview mirror, is growing. There's no question about it. But in the kind of that analogy, right, it's not a unstoppable freight train in which it's growing hand over fist. It is, continuing to grow in spite of some of the headwinds which exist on the right side of this column. We will touch on just briefly a couple of these, and it might stir up some questions. So if you have questions, throw them in the queue. But the first is we'll talk about government deficits. As we've turned the calendar year, a lot of the implementation for One Big Beautiful Bill, OBBB, has now come into place. That is deficit adding to the United States. We started, that or adding to that, where we're starting with our already high level of debt to GDP here in the United States. And this is not a Republican or Democratic comment, because both parties, blue and red, have added to the deficit. It seems to be there are very little interest to structurally move the needle on lowering deficits, either through austerity, higher taxes, or other means. And so here we sit today where we do have pretty material government deficits, and eventually we want to be watching out for when the bill comes due. So we'll talk about what that means for our international diversification and also our fixed income positioning. What do we do with that? On the flip side, on the bright side, consumer spending continues to be very robust. In the United States, it's largely a consumer-based economy. and the consumption is somewhat split. You have the majority of consumption, over 50% of consumption in the United States comes from the top 10% of wealthy individuals, right? So a disproportionate amount of spending from those that have a disproportionate amount of the wealth. Whereas when we talk about the K economy or consumers that are left behind, inflation, right? It's not just a change in rate, but it's milk is more expensive than it was 5 years ago. Some of those consumers, I wouldn't say have been fully left behind. Real wages have grown, but they're not spending on a real basis as much as they were. But because of that larger cohort that's spending the majority here, we still have very robust spending in the United States. And so that's where, again, looking at 2025, GDP is showing solid and extended growth. And then probably just more importantly, as investors, right, as we look at earnings, the economic residual of a business, right? A business sells a product, they have costs, and they have what's left at the end. Earnings have been growing for businesses over 2025 and in a material way. And that is a very good thing for the long-term economy. So robust, but not kind of that unstoppable train, if you will. So it leads us to a position where we want to make sure we balance risks. Now, taking a quick pause before we jump back into the themes and just help level set how we help build portfolios and how that reconciles with long-term planning, right? So financial planning and the work, that you may be doing with your advisors. And the good part of that foundation comes through our capital market assumptions. So we're not trying to allocate portfolios for this week or next quarter or, even a half a year or longer. We're looking over much longer time periods, those of which over a full economic cycle. So we build 10 and 20-year forward-looking capital market assumptions. In short, those are our very best guess of the future. Like any guess, the only thing we know precisely is that it will be wrong, right? But it is a highly probable position in which we think, we can build portfolios from. And frankly, we have done that, building 10 and 20-year capital market assumptions for well over 2 decades. So you can see we established this, we had this call this time last year in 2025, set forward our 10-year capital market assumptions, and we have done the same here in 2026. And across fixed income, you can see there's a very modest decrease across the board. So just by way of example, US bonds, our forecast would be about 4.3% versus last year, 4.7%. Now, the rationale behind that and the reasoning behind that is that, all else equal, as yields in fixed income come lower, right? Think of that as kind of like the coupon, as the potential return comes lower. And by and large, yields from last year to this year have fallen. Fixed income did very well last year. And so by benefit of the increase in that price, yields have come down and our expectations have decreased modestly. Now, that being said, if we zoom out and think about not just the year-over-year difference, which has declined modestly, but the how it sits in a period of time, fixed income overall is still fairly attractive. Now, I will say this is a bit of an eye chart, so let me orient with the chart here. The higher these dots are on the line graph, the more attractive they are over the last 20 years. So that first gray column, cash, that would be cash yield in portfolios today. And the blue dot, that would be, where we sit today. And the yellow, or I apologize, I'm colorblind, that could be an off yellow, is where we were as of last year. So as we mentioned, slightly less attractive than it was the previous year, but still in the upper half of the last 20 years, still fairly attractive. And so as we think about fixed income, even though there's a little bit of red on the screen year over year, we do think that on a long-term basis, that still remains quite attractive. Now, the one exception here is in the bottom right, and it is spreads. Spreads are the technical term of how much additional yield can you have for taking on something that has more risk than a government bond, right? So if you buy a corporate bond, it has the possibility of default. And so by taking that on, I expect a little bit more. Or if it's a non-investment grade bond, right? I expect the probability of default is materially higher than the federal government. And so I expect a lot more. Spreads today are at very tight levels, if not the tightest, pretty close to it in the last 20 years. And so while overall yields are still attractive, in that space, and that's in muni high yield and corporate high yield. We don't think that we're getting paid for the full level of risk there. And so our positions are fairly modest in that space. It's not a spot where we would materially add to risk today. So, like our comments said out of the beginning, making sure that in our current environment, we're balancing risk in a very thoughtful and pragmatic way. Now, turning to our long-term forecasts on equities, right? So same idea, 10-year forecasts here, looking into the future. Year-over-year changes, you can see by and large across the board, some modest decline across the equity markets. It's not uniform. There are areas of the market that have shown opportunity or increased opportunity, but generally prices went up last year, and they went up faster than earnings. And all else equal, that would mean our long-term forecast is valuations are rising, prices are generally falling. And so, our expectations on a forward-looking basis are becoming a bit more modest. Now, we'll talk about international. 2025, it was a year in which we overweighted international in portfolios. I think the EFI was up in the mid 30s, EM was up in the mid 30s. The S&P was up, call it about 18%. So that was certainly a good year for international. It continues to be an area of the market that we'll have interest in, and we'll talk a little bit more in a moment. But year over year, we do find that our capital market assumptions are coming down modestly on equities. Now, similarly, we won't spend too much time with this chart, but you can see, on the cheapness scale, if you will, that equities are far from cheap today. So on a relative basis to history, we do think, again, being pragmatic with risk. So how do we take all of that 10-year capital market assumptions and then start to reconcile it into these three themes that I talked about, kind of key things we think are going to be moving potential prices and volatility in portfolios for the calendar year in 2026. Well, first is the AI playbook. We talked about how we're going to first start with the facts. What's offense? What's defense? And are we in a bubble? Very hotly debated today in markets. Navigating valuations. That's largely what we just discussed about today. 10-year assumptions, a little bit more modest than they have been as of recent years. That's because of full valuation. So it doesn't mean we need to run for the hills by any means, right? Valuations were full last year, and we had extraordinary portfolio results in 2025. It just means that we need to be very thoughtful and intentional about how we manage risk. And then again, that noise-resistant economy, everything we throw at it, right? We keep throwing the kitchen sink at it, and it keeps moving forward. So how does that lay the foundation for some opportunity as we continue to allocate on a go-forward basis? So let's start with the AI playbook. Here, again, we'll start with the B word, which is bubble. Scary word, we know. And if we look back over time, right, bubbles have existed and come and gone, and they usually start with a thread of truth, right? The thing that creates the exuberance around a bubble is usually because it's real, it's material. It is, 1999, right? The advent of the internet and the build out associated with that. The internet truly changed the world. You can go back. There's many, many historical examples. The invention of the radio, the expansion inclusion of railroads across the United States. Those securities or companies that were represented in stocks often went through their own bubble and then came through their own reckoning. And so for those of us that believe that artificial intelligence is real, it's here to stay, it's going to materially impact the future, then we also have to somewhat co-sign the idea that it could be creating, or we are in a bubble. Now, that we do not know. No one knows how the path of artificial intelligence will play out. In many instances, you could look at how this environment compares to past, and you could say, actually, this is very prudent, right? Many of the companies that are involved in AI or AI infrastructure, they are in that market, but they are not taking on material levels of debt. They're actually making more money. And they're investing in R&D with cash flow, not with borrowed funds. That's very, very different from 1999, right? 1999 was far more speculation with the use of debt as opposed to actually creating earnings around those companies. On the inverse, right, we could point to areas of the market that is not being rational, right? And there are a couple of instances, especially in the private markets, where we could say, hey, if it's got AI sticker on it somewhere, even if it's just a bumper sticker, people are willing to pay a lot for it and they're not going to ask a lot of questions. That's not a very thoughtful approach to long-term allocation. So no one knows if we're in a bubble. So what do we do in a market like this, in an instance like this, and how do we manage it in portfolios? Well, the first thing is always start with the facts. So we've had a lot of clients that come and say like, hey, I want to get into AI in air quotes. And my first reaction in those conversations is almost always, you're already there. You just may not know it. So even if we just look at the S&P 500 and we look at all of its components, the underlying, there's actually 505 companies in the S&P 500, believe it or not. And we look at their direct or indirect exposure to artificial intelligence. Almost 40% of the index is directly or indirectly exposed to artificial intelligence. That's a large number, period. If we go back to past periods, we can't use artificial intelligence going back over decades, but if we look at other periods of time and where the market became narrow and focused on one element, right, you're looking at previous highs of in the high 20s or in the mid 30s, like the tech bubble, the tech sector in total, was in the mid 30s in 1999. And so to say that almost 40% of our portfolio is related to AI, if you want to get into AI, guess what? You're already there. If you own the S&P, you're already there. Now you can see it decreases as you go down cap. The Russell 3000 is an all cap. So naturally the math would be small caps have less AI in them, and global, right? So as we think around the globe, AI, while it is predominant here in the US, and most of the exposure in public markets is here in the US and private markets, we do not have a monopoly on AI. If you remember DeepSeek from a little while ago in China. And so, it is already in portfolios. So if someone ever comes to you, or if you're thinking like, man, I got to get on the AI train, guess what? You're likely already there. So then it's like, now that I've got the central set of facts, like, what do I do about it? So there's a couple of things. AI offense, right? Like, how do we want to get on offense when it comes to the opportunity that AI creates? And our portfolios are already exposed to AI through things like some of the largest companies in the world, NVIDIA, Microsoft, Meta, et cetera, that kind of, I think most understand, the exposure is already there. But the AI benefits to businesses, if you have the ability where, in theory, intelligence or a mimic of intelligence becomes free or close to free, that can benefit a lot of businesses, especially those that are smaller businesses that don't have access to either internal employees, external employees, or capital in markets. And so disproportionately, it creates this opportunity, and the market's beginning to recognize that down cap, smaller cap companies could really have a tailwind from AI. And as we look at analyst expectations for the coming year, you do see this reversal, right? Where majority of the benefits were accruing to the AI creators, right? Those that are putting in the R&D, and that's the NVIDIAs and Microsofts, et cetera, of the world. And that's the left side here. The right side in expectations is a lot of that benefit is going to begin to accrue down cap. And so in our portfolios, that's reflected through our mid cap and small cap positioning in two ways. Reasons were there. One, we think there's an opportunity on offense. Two is on defense. As we just mentioned, there is a pretty concentrated bet in large cap US securities. We want to make sure that we don't get too far over our skis on that bet. That also gets us to, small cap valuations here as we think about our 10-year forward-looking capital market assumptions. All else equal, and things are more expensive, they're less attractive. When they're less expensive, they're more attractive. Somewhat intuitive there. Here, small caps are at one of their lowest relative valuations to large caps in some time. Bringing us back to defense, right? So how do we think about not getting caught too much in the fray? And as investors, one of the things we have to think about is the cost of being wrong. Being a great investor is being right about 55, 60, 65% of the time. No one is right 100% of the time. And so we have to think about, if it's 60%, what about that other 40%? What do I do with those errors? And with AI, you can kind of think about it as two errors. One is AI continues to be the thing that outperforms materially, and you don't own enough of it, right? So that would be an error, right? You would underperform the market. The other error would be AI exuberance. Some of the air comes out of that bubble, and AI takes a step back, and the rest of the market takes a leadership position. And if in that environment, right, you own too much of it, that's gonna be painful. And so as we think about kind of the yin and yang of these potential risks, we have to weigh them relative to one another. And so we've built this graph, and I appreciate that there's a lot going on here. So we'll zoom in kind of on this graph and try to enumerate, kind of the pros and cons of this. So on the upside here, right? If you're overweight AI, meaning you own more of it than the market, and it outperforms, you can see that top blue line, it's rising gradually. So the benefit of outperforming, it's there, right? You own more of it and it's doing well, and portfolios will benefit from it. Now, because AI is so concentrated, right? It's coming through a handful of stocks. If the inverse scenario were to take place, right, where AI, some of the air comes out of that scenario, the downside risk is more askew. And so if you are overweight AI and it starts to underperform, the downside to portfolios is far greater. And so as we weigh the pros and cons, we want to make sure that we're exposed in a pragmatic way. And so today, if you look at the dotted line here on the bottom, our global portfolios are slightly underweight AI individual exposures. So it means that if AI is the story of the year, 2026, we look back and we say AI won and everything else lost, we would probably underperform the market slightly. Now, conversely, if some AI kind of takes a break, right, and slows down, or the rest of the market catches up, we would actually expect the skew of that benefit to accrue more in portfolios. And so that becomes that kind of risk balanced approach in making sure that we're pragmatic about how we're building portfolios and very thoughtful around both the offense of AI and the defense of AI. Now, when we talk about, so the next, the $1 trillion question is, everyone keeps asking, will it keep going? Can it keep going? We don't know. Now, this is where we can use history as kind of a telling lesson here, in that companies that continue to grow, the probability that year over year, in the instance of the light blue line, a company grows sales at 10%, or in the dark blue line, a company grows sales at 20%. And then they continue to do that every year or year over year. You can see that as this graph moves on, the air gets pretty thin, right? It's hard to have a repeat winner over and over and over again. And so in that environment, that's where we start to think a lot more about the balance of risks. Now, one of the ways to balance risks, right, which we've already done, and we'll summarize in just a moment and take questions, is on portfolio allocation, right? A thoughtful allocation between stocks and bonds that reconcile with your planning. Thoughtful allocation to geographical exposure, or large caps versus small caps. So we'll sum that in just a second. The other, which is somewhat left for dead a little bit amongst many clients, is the idea of hedge funds. Now, in many instances, hedge funds are tax inefficient, right? So we have to be thoughtful and aware of that. They can carry lower liquidity than we have come to enjoy in public markets. But all that said, if we start to break down those barriers and have a conversation around, in an environment where valuations are full and potential volatility is high, but we don't want to be market timers. We don't want to be pulling money out of the market and just waiting for the smoke to clear, or whatever the proverbial phrase would be. A hedged alternative is a pretty attractive way to do that. The screen here shows that in past periods of drawdown, hedge funds, almost in the name which they imply, have shown kind of greater downside protection in some of the largest drawdowns for the S&P, the MSCI EAFE, which is developed international equities, and EM, which is emerging markets. So it's not a blanket, this works for every individual in every instance, but it is an area to explore. Should you do it through, in a tax efficient way? And should we do it with full eyes wide open on the potential liquidity that it may draw from the portfolio? So in summary, and then we'll draw on questions and Mitchell will call you back in here. So in this environment, right, not a time to reach, right? As we mentioned, kind of few fat pitches. We know that there are exogenous potential elements out there, whether it's not even in the calendar year of 25, but Venezuela, Greenland, a number of others came in. We want to be cognizant of those things in our portfolio construction and design. In 2026, right? Maintaining that overweight to non-US, that was a very beneficial position for us in calendar year 2025. We believe that it will continue to be accretive in 2026 and also in small caps. We talked more about that here and how AI offsets could be rotating in the benefit, accruing down capitalization versus just up. Alternatives kind of gave the quick commercial there. And I just want to mention, it's worth mentioning, Wealth Crossing and Fiducient, we make no more or less money if you own alternatives. That's not always the case with all advisors around the country. Our pure allocation is if it helps our clients meet their planning and objective goals, then it's a resource that we want to use, and there's really no other motivation behind it. And so in this environment, alternatives could be an opportunity to help achieve those long-term goals. And then AI, right? We can't go anywhere without bumping into AI. But first, start with the facts. If you want to be in AI, guess what? You're already there. Two is let's be thoughtful around what offense means. How can we be proactive with AI in our portfolios and make sure we're accruing the benefit where it makes most sense? And then defense. How do we have the right amount of exposure in the right ways and not get caught too much on the exuberance of this too will change the world? Because that generally tends to be a recipe of greater downside exposure. So I'll pause there. I know I went through a lot. Mitchell, we can see if there are other kind of Q&A or questions, or if you've got anything queued up that we want to get into.
Perfect. We got a few questions. I'll start with one now. What they asked, the devaluing of the dollar relative to other economies has been on the news recently. What are your thoughts on that? And what can you have in the portfolio to protect against any future weakening?
So it's a great question. First, I would separate two things: the weakening or devaluing of the dollar, and the dollar is the reserve currency of the world. We can have a weaker dollar and still have the US dollar be the reserve currency of the world. So that's like as just kind of laying a base. There is and has been more dollar volatility, 2025 included, into the downside. We talked about it on the economy items up front. Government deficit is a big issue. All else equal, when federal deficits, US deficits are higher, while in theory, right, the potential for default is rising, I think there's some practicality elements of that. It makes other countries want to step away from owning more dollars. Also, the United States actions around the globe in recent years, you could view them as rightly or wrongly, has led some foreign nations to not want to put all of their proverbial eggs in one basket. Great example of that is Russia. When Russia was sanctioned for its invasion of Ukraine, they were cut off from the access to the SWIFT system. When they had Russian money in US dollars, it was kind of held back. And so that has led some foreign nations to say, hey, maybe I shouldn't have all of my money in treasuries. It's one of the reasons that we've seen a run in gold. Some of those foreign nations have been stockpiling either physical or paper gold as a proxy for treasuries. So, there is, and then the final and third thing, we'll probably get another question on it, is the independence of the Fed. I'll give you kind of the bow on that. And if we want to get into it later, is we believe that the Fed remains independent, albeit imperfect. The Fed has never been perfect. History is evident of that, even recent history, but it still remains independent. But the more you call that into question, the more it seems you would have political influence over long-term economic decisions, and that creates a level of instability, which creates a level of instability in the dollar. And so the likelihood of a weakening dollar it's possible, and we've seen it as of late. And it's one of the reasons we have global positioning in our equity portfolios. Our equity portfolios benefited materially from a weakening dollar last year, and they've benefited year to date. If we were just to, we're 28 days into the year, the S&P is up a bit, and international emerging markets are up quite a bit more. That has continued to be part of that story. So having that global diversification is important. The final component there is small caps, a little bit of a benefit. Global larger entities, large caps, tend to trade, either purchase or sell goods around the globe. Then you've got currency adjustments there. Small caps, this isn't a perfect example, but small caps tend to be more insular, kind of between New York and California. They buy and consume more domestically and aren't as exposed to the dollar. So it's a great question, and frankly, one I think we're positioned well for.
Perfect. Thank you. Kind of going back to your Fed question, if there is a new Fed chair that kind of lowers rates, as some folks have been calling for, how do you think that affects kind of longer term rates? Will they fall as well, or will they kind of diverge?
Yeah. The Fed chair is important, but let's remember just kind of governance structure, much like the founding fathers set up the three branches of government with, balance of control between the legislative, executive, and judicial branch. When the Fed was incepted in the early 1900s, a similar level of balance of control was established. So you have Fed governors that are appointed by the sitting president. They're appointed for a 14-year term. That then rolls over time. Now, most governors do not fulfill their own 14-year term, but nonetheless, you have this rotating governorship. And then you have the rest of the FOMC committee, the committee that sets policy around short-term interest rates and overnight lending rates. That includes other permanent members, of which the executive branch does not appoint and has no direct authority over. So even if, I was the Fed governor and I walked in and said, lower interest rates today, I have to convince my other governors and permanent bank representatives from around the country, from various regions, to say that is a good idea, because those are all independent votes. There's no question, whomever is appointed as Fed chair and fills the next seat, they are going to be on the lower rates train. President Trump would not appoint anyone other than someone who wants that opinion. And at least in a way, his willingness to meddle in the Fed is very open about his intentions, almost comically so. Yet that Fed chair cannot walk in the room and say, hey, guess what? We're lowering rates. So with that, we believe that the Fed still maintains its independence. We believe that it's likely the Fed will continue to cut rates. Just by way of fact of where we are in the economic cycle. Inflation is modest. Labor is slightly weakening. And so you combine those two things, we should be modestly lowering rates and pragmatically over time. That being said, it's not going to be at the full dictation of the Fed chair. So it'll be interesting to see over the coming weeks, but it's not going to be that one individual will not be the thing that drives long-term outcome.
One more here related to how do you balance kind of monitoring valuations as a planning tool on the equity side versus trying to use them as a market timing tool?
Yeah, to be honest, it's a horrible market timing tool. If you look at high valuations and you roll forward 1 week, 1 month, 1 quarter, 1 year, there's very little indication that it's going to tell you something meaningful. If you're trying to time markets, which by the way is a fool's errand, there are better ways to do it. Now, that being said, valuation over the long term has a very influential indicator of return or lack thereof. So it's a great anchor for planning, right? So the 10-year and 20-year capital market assumptions that we build go into financial planning and modeling. It helps us set risk and expectations around level of volatility and return. But, as even noted in the question, it's not, and we are not, market timers. So it's an important tool, and probably if you get to close your eyes where you want to put the majority of your risk, Luckily, though, it's not our only tool, right? As we look at the economy, as we look at markets, not just from valuations, but earnings and earnings growth, relative dispersion, weakening of the dollar, like all those things come into play as we build portfolios. And because we don't get to control the future, we're trying to build a portfolio that has a high probability of achieving our long-term goals with the least amount of risk possible, because it's not fun to take on more risk, right? It's only detrimental. So how do we build the highest probability? One of the ways we do that is reconciling with long-term valuations and what they mean to both planning and investment horizons.
We did have one more come through kind of asking about the performance of active small cap managers versus kind of the performance of passive indexes in 2025 and what you think that means moving forward for 2026.
Yeah, there's some nuances for sure in small cap, both index construction and active managers. That market has changed substantially over the last decade. If we use the Russell 2000 as a proxy for small caps, almost 40% of that index contains companies that are what are called non-earners. So effectively businesses that don't have positive earnings. So they sell a product and they have revenue, they have expenses, and their expenses are more than their total revenue. And so they have negative or very low or zero earnings. Most of the time, as an active manager or an investor, you want to look for a business that is making money, not losing money. And so it creates this embedded bias, if you will, of the active management community in small caps vis-a-vis the index. That being said, in aggregate, active managers, some did very well in 2025. Others did very poorly, mostly because, but not, you can't excuse everyone, mostly because of that embedded bias. If we look, very short, but, slightly turning of the tides year to date, not only are small caps outperforming large caps, but in aggregate, many active managers are doing well vis-a-vis the index. In all things investing, that tends to be cyclical. Like you seem like you were an idiot yesterday and then you're a genius tomorrow and then vice versa. So in any one cycle, it will not always persist. But I do think that it actually adds to both, the opportunity in small caps and being thoughtfully active there, where, you can take, the right horizon for investing, right, which is tough in any given calendar year. That could create a pretty substantial opportunity in 2026.
I think that was all the questions we had time for. We wanted to thank everyone who joined us and asked any questions along the way. If you have any additional questions, please feel free to reach out to your Wealth Crossing team, and we'd be happy to talk through those with you. We'll also plan to circulate a replay of the webinar for those who may have missed something and would like to rewatch. And thanks again, everyone. Hope you have a great afternoon.
All right. Thanks, everyone.